Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. Today we are going to look at one out of the consumer staple sector. It is May 6th. We're going to take a look at Tyson. Let's jump right in the video. Before we get into the video, if you could do me a favor, hit that thumbs up button if you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you think of the video. Let me know what you think of Tyson. Is it one in your portfolio? Is it one you're watching? Is it one you're avoiding altogether? And doing all that really does help out a small YouTube channel like mine grow with the YouTube algorithm. So I really do appreciate it for all of you who have taken the time to hit the thumbs up button. Make sure you're subscribed. Make sure the notification bell is turned on. Thank you so very much. Now, this is the vested interest stock screener. This is how I look at a company on a high level to see if I am interested. It's an initial screener that I use to make sure the company is meeting some criteria that I've set up. Now, you should adjust your criteria based on your investing criteria, but you could use this as a starter if you wanted. Just because it meets the screener, 5 of 8 or 6 of 9 if it's a financial company, does not necessarily mean I'm investing in it. It means it goes on my watch list, and then I do more of a deep dive into the financials of the company and then work out a price I'm willing to pay, typically by doing a discounted cash flow analysis, and then I wait for the price I'm willing to pay to align with the price of the stock. This is also how I set up the stock pick of the day videos. So we're going to look at this screener here, run through each one of these in the video, and at the end I'll give you a tally of where it fits and whether or not it would meet the screener or not. Now back to the video on Tyson Foods. You can check them out on their homepage, www.tysonfoods.com. That's www.tysonfoods.com. That is their homepage where I pulled this information from, and that's where you should start. You should understand the company. What do they sell? How do they make their revenue? How do they make their money? What are their brands that they're under? And as you can see here, I did clip out the brands. You're probably well aware of these. You may have some of these in your refrigerator at home. Tyson, obviously. Tyson Jimmy Dean Sausage, Wilshire Farms, Hillshire Farms, Ballpark, right? Frank, so hot dogs, IBP, Lady Astor, Mexican Original. Some of these I'm not familiar with. A lot of them I am. Ballparks, Hillshire Farms, Jimmy Dean, Tyson's, those one I am. Adele's, State Fair, I've heard of that one. Raised and Rooted, I've never heard of that. Sara Lee, pretty popular brand there. Pretty sure you know that one. Wonder Bar, Advanced Pierre. You can read the rest of these, but again, some pretty well-named brands under their overall umbrella. Yeah, I don't know why I'm having trouble talking today. Tyson Foods is a modern, multinational, protein-focused food company producing approximately 20% of the beef, pork, and chicken in the United States, in addition to a portfolio of foods under the Tyson, Jimmy Dean, Hillshire Farm, Ballpark, Wright, Adele's, and State Fair brands. Tyson Food is also the leading protein provider to many national restaurant chains, including quick service, casual, mid-scale, and fine dining restaurants. We make great food for a variety of food service customers, including schools, military bases, hospitals, nursing homes, international customers as well. We are also the only company that sells chicken, beef, pork, and prepared foods products through all major retail distribution channels, including club stores, grocery stores, and discount stores. So there you have it, from schools to restaurants to your local grocery store, they are providing, it says 20% of the beef, pork, and chicken for the entire United States. And again, some pretty well-known brands here, especially Tyson, Jimmy Dean, Hillshire Farm, Hillshire, and Ballparks. State Fair is another big one. Again, I know that one. Some of these other ones I've just never. Brian, I've heard of that. Some other ones. Check them out on their homepage, www.tysonfoods.com, if you want to know more about them. Now, the reason we are taking a look at them, down 5.68% on the day. Big drop on the day. Close out the day at $58.50. We are talking about Tyson Foods Inc, ticker TSN, out of the consumer staples sector. 52-week range as low as $44.94, as high as $61.71. Market cap of $20.885 billion. Their beta is 0.75, so they are less volatile than the overall market. Now, this is where things start to get wonky. They are not listing a PE ratio, price to earnings ratio, so I'm assuming that means they're negative. That's not a good sign. Earnings per share is listed as negative $2.47 per share. That's not a good sign. Earnings date was May 6th. So I'm assuming today some bad earnings, either they missed or their future projections were lowered, guidelines were lowered, something here. They may have missed on the top line. They may have missed on the bottom line. They may have missed on both. You want to check that out. I don't cover their earnings on this channel, but you could definitely take a look at them. They are out today. So I'm assuming this big drop, 5% drop on the day, is because of some negative earnings reported. Forward dividend is at $1.96 paid out on the year. They do have a nice starting dividend yield, 3.16%. Is it safe? That's what we're going to look and see. Ex-dividend date, May 30th. So their ex-dividend date is at the end of the month. If you were to buy them now, you would be in line for their next dividend payout. And you want to buy the day before the ex-dividend date to make sure you get that dividend if you are interested. Sometimes when you buy it on the ex-dividend date, your brokerage may not count that. They may take who owns the shares at the end of the day on May 30th or the beginning of the day on May 30th. It depends on how they list who owns those shares. Right, so I always say buy it the day before the ex-dividend date to make sure that you get the dividends associated. 1 year target estimate, at least according to Yahoo Finance, where I pulled this information from, of $60.90 per share. So they see some slight, ever so slight upside in the price per share appreciation over the next year, and that is not much growth over the next year, even if it was to get that $60.90, right? It's currently below that, but not by much. Now we're going to take a look at dividend yield theory to see if this one is potentially showing some undervaluation. To do that, if you were to go to Yahoo Finance, you go over here on the left, you'd click on statistics. There's other tabs you can click on, analysis, financials. In this case, we're going to click on statistics. We're going to go down to dividends and splits. We're going to look at the 5-year dividend yield average, 2.61%. We compare it to the current, 3.16%, or over here forward annual, 3.16%, same number. And since it is higher, right, than their 5-year average, that speaks to some undervaluation. Dividend yield theory is inversely correlated. So 3.16% higher than their 5-year average, that speaks to undervaluation. If this number was under their 5-year average, that would speak to overvaluation. So according to dividend yield theory, this one is potentially undervalued. Now here's where dividend yield theory and the payout ratio, you need to pair the two to make sure that even though they are potentially undervalued, is the dividend safe. The payout ratio, according to Yahoo Finance, is 202.13%. That's too high. I want under 75%. So this is way higher than I want. They do not have enough free cash flow to cover their dividend. That means it is in jeopardy of being cut. And we've seen a lot of dividends cut recently, right? 3M just cut their dividend. Several others have recently cut their dividends. Intel last year was one I had that cut its dividend. MPW is another one that I had that cut its dividend. So companies will cut their dividend, and a very clear indication of one getting ready to do so is when a company's payout ratio is over 100% or even over 75, 80%. It starts to get really critical to start watching that, because that doesn't give them much room for error. So this one is a potential dividend cut, in my opinion, and even though dividend yield theory says it's potentially undervalued, this right here, this payout ratio of 200%, over 200%, is screaming this is one to beware of. Now we're going to take a look at the financials. Same thing, if you were to go over here on Yahoo Finance's homepage, just to the left of this chart, you would find all those tabs. We're going to go down to the financials tab. We're going to take a look at free cash flow. There's a lot of good information under that financials tab. You're going to find their balance sheet, their income statement, their debt to equity ratios. Do they have more assets over liabilities? Is their revenue growing over time? Are their margins expanding over time? Are they buying back shares or diluting you as a shareholder? Are they paying down debt? Lots of good information there. You should understand how to read a balance sheet and an income statement. If you don't want to do that, you should stick to ETFs or index fund investing. VOO, which is the S&P 500, or another ETF or index fund that tracks the S&P 500, is one that Warren Buffett has suggested for years. You can also look at something like VTI, which is the total United States stock market. SCHD is one that focuses on dividend growth investing, or VYM. Those are two good ones. So if you don't want to do the research involved in looking at individual stocks, stick to ETF investing or index fund investing. That's where you should park your money. Then you can just dollar cost average in every week, and you don't have to do any research at all, which is fine if that's what you want to do. On this channel, I do a little bit of both. So we're going to go back and look at their free cash flow. We want growing free cash flow over time, because dividends are paid out of free cash flow. And typically, if you have growing free cash flow, you will have growing dividends to go along with it. Going back to 2020, you can see here $2.6 billion. 2021, $2.6 billion. So down a little bit, 2.675 to 2.63. really down in 2022, down to 800 million, and even worse in 2023, negative 187 million. So this is going in the wrong direction, and that's a trend from 2021 to 2022 to 2023, definitely going in the wrong direction. Now, they did repurchase a big tranche of shares here in 2022. I'd have to do the math. I don't know if that accounts for, almost 2 million share, or almost $2 billion in free cash flow decline, and it certainly does not account for the repurchase of shares in 2023. So overall, we are seeing decreasing free cash flow, but I do like that they are repurchasing their own shares, especially if they are potentially undervalued right now. That's when you want a company to do that. Now, I always recommend more than one source. Another one that I like is stockanalysis.com. You pick any sources that you like. Just make sure you're not blindly trusting just one source. Now, they have 11 analysts that have taken a look at this. They call it a consensus hold, and I would tend to agree. I would not be adding to this. I would not be buying this right now. Heck, it may even be a sell for me, based on some of the numbers. But let's go through the rest of the numbers here. They have a low estimate of $45, right? So they see further for it to drop, which would be a 22.53% decrease from where it currently sits. Average estimate of $57.82, which would be a 0.46% decrease. And if it happened to hit their high, that's the only way you're making any money. $70, that would be a 20.5% increase from where it currently sits. You could collect that 3% plus dividend yield, so long as they kept it and didn't cut it, that is. Now, we're going to get into statistics here and look at how efficiently this company is using its capital. To do that, we go into return on equity and return on invested capital. I like 10% or better for both of these metrics. Not looking good here. Return on equity, negative 4.6%. Return on invested capital, negative 2.27%. So it does not meet the metric that I'm looking for there. EPS growth, I typically like 5% or better forecasted over the next 5 years. They do not list it, so that tells me that they probably believe EPS growth is either going to be flat or is going to continue to be negative, which is not good. They do have revenue growth forecasted at 1.88%, which is very slow growth if they hit those numbers. So far, the numbers on this one are not looking good. Let's look at the dividend history real quick and wrap this one up. So they are a quarterly payer. Again, payout ratio, they're not even listing it. Yahoo Finance had it at over 200%. Not good. Dividend growth, very slow, 2.63%. And with a payout ratio over 100%, they shouldn't be growing their dividend at all. They should be probably decreasing it and paying down debt. 3 years of dividend growth, so they've only been growing it for 3 years, and they're already in trouble. Buyback yield of 0.84%, shareholder yield of 4.23%. Going back to 2021, November, they were paying 46 cents. November 2022, they jumped up to 48 cents. November 23, up to 49 cents. I would suggest they cut their dividend, but if they continue to raise it, it'll probably be in November, and they pay out on the March, June, September, December timeframe. So going back to our stock screener, we take a look at the business, right? They sell protein, whether it's beef or pork or chicken. That's their main. They sell it to schools. They sell it to military bases. They sell it in your local grocery store. They do not have growing free cash flow. Their dividend is growing, but should it be? But it is a check. Dividend payout ratio of 75% or less. Nope. Dividend yield theory is saying it's potentially undervalued, but with a 200% payout ratio, that's not a good sign. Below current cost basis, it's not in my portfolio, so that doesn't apply. It's not within 15% of its 52-week low. I think it'd have to drop below $51 to be there. Return on invested capital, return on equity, equal to or greater than 10%. Nope, it was negative for both of those. And earnings per share growth equal to or greater than its industry average, or 5% plus. It did not meet that metric either. So with only 3 checks, it does not meet 5 of 8 or 6 of 9. It's not a bank, so I'm not using price to book on it. But I did happen to look at that. It's even price to book is would not be under a 1 either. So it does not meet the metric to even go on my watch list. It is not one that I am interested in right now. They need to get their financials in order. It just is what it is. Let me know what you think. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And make sure that notification bell is rung. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like this one that you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below and I'll work it in the rotation. I do need to do one on Visa. That was one suggested. I do have that on my list. We will get to it at some point. There have just been quite a few that have really dropped down I've wanted to get to sooner. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk, can lose money, and should never invest any amount that comes to losing. Always do your own research and invest based on your situation, circumstances, and select criteria. Always seek the advice counsel certified financial advisor.